Most people watching this didn't mess up their finances. They followed the rules. They worked hard, paid their bills on time, avoided obvious mistakes, and when the moment came, they did what they were told was responsible. They bought a home, and yet, month after month, year after year, something feels off. The money keeps moving, but the freedom never arrives. That quiet gap between effort and outcome is not an accident. I'm not here to shame you, and I'm certainly not here to say you did something reckless. I'm here because I've watched this same pattern repeat across decades, across interest rate cycles, across housing booms and crashes. There is a decision that society celebrates as maturity, stability, and success, while quietly draining liquidity, flexibility, and peace of mind. Most people never question it, because questioning it feels like questioning adulthood itself. But finance doesn't care about applause. Numbers don't reward tradition. And if you've ever wondered why doing everything right still feels financially tight, you're not imagining it. Long before most of us ever ran the numbers, we were handed a script. Not written down, not signed, just repeated so often it felt like common sense. Rent is throwing money away. A mortgage is forced savings. Owning a home means you've made it. This idea didn't come from math. It came from parents, grandparents, teachers, commercials, and smiling real estate agents on park benches. Over time, it stopped sounding like advice and started sounding like morality. Good adults buy, responsible people buy. If you don't buy, something must be wrong. That pressure sinks in quietly. By your late 20s or early 30s, renting doesn't just feel temporary, it feels embarrassing, like you missed a step everyone else figured out. And once a belief becomes tied to identity, it becomes dangerous. Because at that point, you're no longer asking whether the decision makes financial sense. You're asking whether it makes you look grown up. I've seen people stretch their budgets, their nerves, and their futures, not because the deal was good, but because the script told them it was time. And scripts are powerful. They don't ask permission. They just keep playing in the background until you act. That's where the pressure turns personal. It's no longer an abstract idea about responsibility. It's a feeling in your gut when someone asks where you live. It's the pause before you answer. It's the quiet comparison when friends start posting photos of keys, driveways, and sold signs. Renting at a certain age is treated like a phase you should have outgrown. And that's when fear starts dressing itself up as wisdom. People don't buy homes because the numbers are compelling. They buy because the alternative feels like falling behind. They panic not because prices are low, but because time feels like it's running out. I've watched perfectly rational adults convince themselves that stretching a debt-to-income ratio to the breaking point is just how it works now. Signing a 30-year mortgage becomes a way to silence doubt, not solve it. The moment the deed is signed, the anxiety doesn't disappear. It just changes shape. Because when a financial decision is driven by shame instead of clarity, it doesn't create security. It creates a trap that looks responsible from the outside and feels suffocating on the inside. This is the point where people expect reassurance. They expect the reminder that it will all be worth it in the long run. But comfort isn't my job here. For millions of people in today's economy, a primary residence is not an asset. It is a liability wearing the costume of an investment. That doesn't mean it's a bad place to live. It means it behaves very differently than people are told. An asset pays you. It creates cash flow. It expands your options. A house does the opposite. It demands payments, attention, and commitment, whether your income is rising or not. You're not paying yourself each month. You're renting money from a bank and calling it ownership. And the math behind that arrangement doesn't care how proud you felt on closing day. To understand why this matters, you have to look past the sale price and focus on the money that never comes back. This is where the illusion finally breaks, because this is the part no one likes to advertise. When people say rent is throwing money away, they're not wrong. That money is gone. But what they don't tell you is that a massive portion of homeownership works the exact same way. In the early years of a 30-year mortgage, roughly 70 to 80% of your monthly payment goes straight to interest. That money does not build equity. It does not increase your net worth. It disappears into the banking system. You might write a $3,000 check every month, and only a few $100s actually reduce your loan balance. The rest is vapor. Then come property taxes, a permanent monthly rent you pay to the government for the privilege of staying where you already live. In many parts of the USS, that alone rivals the cost of renting a modest apartment. Add homeowners insurance, which keeps rising with climate risk, and maintenance. The quiet 1 to 2% of your home's value you'll spend every year fixing things that wear out, break, or fail without warning. Water heaters, roofs, foundations. None of it builds equity. And finally, there are transaction costs, agent fees, closing costs, inspections, staging, buying, and selling can quietly consume up to 10% of a home's value. When you add it all together, interest, taxes, insurance, maintenance, and fees, the unrecoverable cost of owning often matches or exceeds the cost of renting the same home. You're not building wealth. You're just paying a different landlord, one made up of banks, governments, and hardware stores. Once you see unrecoverable costs clearly, the question stops being emotional and becomes mechanical. There is a single number that cuts through the noise, and it's one most people are never taught to calculate: the price-to-rent ratio. Think of it as the P/E ratio of housing. You take the purchase price of a home and divide it by the annual cost to rent a comparable one. If a house sells for $500,000 and rents for $2,000 a month, that's $24,000 a year, giving you a ratio a little over 20. Historically, ratios below 15 favor buying. Ratios above 20 favor renting. When that number climbs into the mid-20 seconds or higher, the math stops whispering and starts shouting. In many major U.S. cities today, that's exactly where we are. And when the ratio is that stretched, you're not paying for shelter. You're paying for exposure to a very expensive bet. Here's where the story flips, and where a lot of people get uncomfortable. When price-to-rent ratios are stretched, renting isn't a failure. It's a position of advantage. As a renter, you're effectively living inside a high-priced asset without having to finance it. You get the shelter, the location, the lifestyle, while someone else absorbs the risk. The boiler breaks, the roof leaks, the foundation shifts, the market pulls back. None of that lands on you. You're consuming housing at a discount, while the owner is speculating on appreciation. In practical terms, you're living in a $1 million asset for a fraction of what it would cost to carry it. That difference matters, because every dollar you don't lock into interest, taxes, and maintenance is a dollar that stays liquid. And liquidity is freedom. It's the ability to adapt, to invest, to respond when opportunities appear. Renters don't look powerful on paper, but quietly, structurally, they retain options. Homeowners give up. This is the part that does the most long-term damage, precisely because it's almost never discussed. To buy that $500,000 home, you're usually asked to put down 20%. That's $100,000 in cash that doesn't go into a business, a portfolio, or an income-producing asset. It gets sealed inside a wall. That money is no longer working for you. It's just sitting there, illiquid and silent. It can't pay your bills. It can't be rebalanced. It can't be redirected when conditions change. People call this equity, but in practice, it behaves like dead weight. If that same $100,000 were invested in a broad U.S. stock market index, historically returning around 10% annually, it would be expected to double roughly every 7 years. By locking it into a single local real estate market, you're making a concentrated bet that one neighborhood will outperform the global economy. That's not conservative, that's speculative. And when your capital is locked, your life starts to lock with it. Because money that can't move eventually limits the person attached to it. Liquidity isn't just a financial concept. It's a lifestyle asset. When your money can move, you can move. In a fast-changing economy, that matters more than people realize. A better job offer, a lower cost of living city, a healthier environment, These are financial opportunities disguised as life decisions. Renters can act on them quickly. Homeowners can't. Selling a house means agent commissions, closing costs, repairs, staging, and months of uncertainty. One decision can erase years of paper equity in a single transaction. Buying a home is a bet that your current location will serve you well for the next 7 to 10 years. If you're wrong, the exit fee is brutal. Renting buys you optionality. And optionality has real economic value. It reduces risk. It increases leverage over your own time. When people say owning a home gives stability, what they often mean is it removes flexibility. And flexibility, in modern finance, is often the difference between feeling stuck and staying ahead. At this point, someone always says the same thing. Rent goes up. A mortgage is fixed. And they're right, to a point. A fixed-rate mortgage is a hedge against inflation, but that hedge is incomplete. While the principal and interest stay the same, everything else moves. Property taxes rise as cities look for revenue, insurance premiums climb with climate risk, labor and materials get more expensive every year. Inflation doesn't disappear. It just shows up in different places. And while rent increases over time, so do productive assets. If the money you keep liquid by renting is invested and compounds at 7 to 10% annually, it has the potential to outpace rent increases that average closer to 3%. You're using appreciating assets to pay for housing, instead of letting housing consume your capital. This is where spreadsheets usually stop, but real life doesn't. Home ownership isn't passive. It's a part-time job you never applied for. Weekends disappear into Home Depot runs and repair lists. A strange noise in the basement isn't an inconvenience, it's a bill waiting to happen. You don't just own the house, you manage it, you worry about it, you mentally carry it. When you rent, that weight is outsourced. Something breaks, you make a call, and your time stays yours. That time has value, even if it never shows up on a balance sheet. Time to rest. Time to learn a new skill. Time to take on work that actually increases your income instead of maintaining a depreciating appliance. Many people buy a home chasing stability and end up purchasing anxiety instead. Renting doesn't just preserve capital, it preserves mental bandwidth, and that bandwidth often turns into higher earning power over time.